Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over a Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here is your host, Mike Alkin.
Welcome to the podcast. It is May 1st, Tuesday, 2018. Hope you had a great weekend. As usual, I'll share a little bit about mine. Weather continued to be nice here in the Northeast, so that was exciting. I was busy between lacrosse, my kids having a lot of friends running in and out of the house. I have a boy and a girl, and our house is like Grand Central Station, which is nice. It's nice to have a lot of people over. You know, it's nice to be the hub for where my kids' friends want to come. Keeps it busy, but it was good. We had a friend of ours had a confirmation party yesterday, and that was nice. So I did something I haven't done in a really long time on the weekend, and that is very little work. You know, normally I'm reading, I'm doing a spreadsheet, I'm doing something about the day. You know, whenever I could sneak away for a little bit, I run into the office and I get some stuff done. But it felt good. I didn't do a lot at all. Actually, one of my subscribers he sent me an email and he said, I know you watch Billions and I know you like Homeland. I must have mentioned it on one of the podcasts. And he said, you should look at The Blacklist. So I had a little time during the week. I started it and it's spectacular. John, I want to thank you for that. I am now binge watching on Netflix The Blacklist, which is fascinating. It's about the FBI and black ops, and if you enjoy those type of shows, I would highly recommend it. So not only am I watching it, I mentioned it to my wife, and she is now binge watching it, as are my two kids. So it was nice. Got a little bit of time doing that this weekend. The NFL draft was on Thursday. My Jets, they picked Sam Darnold. We'll see. USC quarterback. You know, USC pretty boy quarterback. I could be a little harsh. We'll see how he adjusts to the harshness, the harsh environment of the Northeast playing football here. He's a big kid, big arm. Comes highly touted. So we'll see. I'm not sold, but I hold out hope. But then again, I'm a Jet fan, so it's hard to be sold on anything. Actually, one of the guests today I'm bringing on is a buddy of mine who I've known for probably about 12 years, and he is a former NFL linebacker. And he is going to be talking with us about, he was a walk-on at Wisconsin in the Big Ten. He was also undrafted into the NFL and had a 6-year career. So he's going to talk to us about the similarities between professional football and investing. And it's pretty fascinating. So I think you'll enjoy the conversation. I have another guest on the show. So this is a two-parter. Maybe it's going to be lengthy. And for those of you who don't like the long podcasts, I'm warning you in advance. It's 2 parts. It could run close to 2 hours, maybe more. I'm not sure. You could listen to it in 2 different segments. You'll get a break in between. You could download the podcast, or you could download the transcript if you like over at Curzio Research. But I'm bringing on a friend of mine who is a professional short seller and I've known him over 20 years, and I've seen his work. And I want to give you some insights into what someone who's making their living betting against stocks going up, what they're looking at. And it's not all that you think, bad guy short sellers. Some companies come out and blame the shorts. I've been a professional short seller for over 20 years, and I can tell you it requires tremendous due diligence in the field, tremendous analytical research, and the folks I know that do short selling are just hardworking, smart people looking for cracks and chinks in the armor, great cracks in the armor. That's what they're looking for, kinks in the armor. So anyway, we're going to get some insight into that. But we are in the heart of earnings season right now. And what I wanted to do was walk you through how I think about that and how I use current and past earnings seasons to help form my overall market view. Now, if you've been listening to the podcasts since they started, I think back in early February, you've heard me ring a cautious tone. I'm not being bombastic. I'm not out there jumping up and down saying the market's crashing tomorrow. I'm saying that I think you really need to be cautious. And there's reason for that. So let's take a look. Let's walk you through what I'm thinking, right? So I start to look at, did the fourth quarter give us a hint? Now, in the fourth quarter, 73% of the companies reported actual earnings above the mean estimate, above what the average Wall Street consensus was. Now, the 5-year average is 69%, so that was good. Now, earnings exceeded expectations by 4.4%, slightly above the 4.3% 5-year average. Now, due to these surprises, the earnings growth of the S&P was 14%. Now, going into the fourth quarter earnings reports as of December 31st, the expectation was for 11% growth. So we saw earnings growth year over year of almost 15% and exceeding the 11%. Given the stronger performance of companies relative to the estimates and the improvement in the growth rate over the past few years, you would have thought that the market would have responded pretty well. And we're going to talk about that in a minute. Now, if you think about the companies in the S&P reporting positive earnings surprises, you would have expected to see the prices increase, stock prices increase. What we saw was a decrease in price of 0.2%, about 20 basis points, from the 2 days before the company reported the results to the 2 days after the company reported the results. Okay, so what does that mean? Over the past 5 years, companies in the S&P have reported positive earnings surprises, who have reported positive earnings surprises, saw their price increase 1.2% on average during that 4-day window. So this was the largest average price decline over this 4-day window for S&P 500 companies that have reported positive sales surprises since the second quarter of 2011, when that was down 2.9%. And it also marked the second time in the past 3 quarters in which the S&P 500 companies reported positive sales surprises, but recorded an average decline in price over that same 4-day window. In Q3 17, the S&P companies that reported positive surprises saw an average decline of 0.3%, 2 days before the report to 2 days after. So what happened? After all the companies reported, what does that mean? Let's translate that into what the S&P, when I say the market, it hit 2872 on January 26th. Now, the value from that point fell 10.2% over the next 9 trading days. It closed at 2581 on February 8th. Now, during this period of declining value, 29th of January through February 8th, 204 S&P 500 companies had reported results for the fourth quarter. By the time the quarter had ended, the reporting season had ended, the S&P rallied 8% to peak on March 9th at 2786. And that was 3% below the highs of January 26th at 2872. And if you recall, I said the earnings growth came in at 14.8% versus the 11% was expected. So at the end of earnings season, earnings expectations increased, or actual earnings were much higher than expectations, yet the stocks had not recovered from before the earnings season started. Okay, so that's the backdrop going into first quarter earnings, what we're in right now. So you've heard me say before, we want to think about where the puck is going, right? What's the market expecting? And for that, I have a little historical context. I know how they did in the third quarter, as I just mentioned, and how they did in the fourth quarter. So I start to look at different time frames. As I'm thinking about it on April 6th, I'm looking at it. And for the first quarter, 52 companies in the S&P 500. Now, this is before earnings started to get into swing. 52 companies in the S&P 500 had issued negative EPS guidance, and 53 issued positive guidance. The number of companies issuing negative guidance was well below the 5-year average, which is normally 80 versus the 52 that was just reported, that was reporting negative. And the number of companies issuing positive earnings guidance was well above the average of 28. We had 53 doing that. So at 53, that's the highest number of S&P 500 companies issuing positive guidance, dating all the way back to 2Q 2006. The previous record for the number of S&P 500 companies issuing positive guidance was 47, which was Q2 2010. And when we look at it on the sector level, information technology had 38 companies doing it. Consumer discretionary had a bunch of companies, and all taking guidance up. Now, that's not surprising with those two companies, because historically those two sectors, those sectors have the highest number of companies providing quarterly earnings and so on average. But what was surprising was the unusually high number of companies issuing positive EPS in the information technology sector. I mean, that was way off the charts. The number of companies that issued positive guidance was 26, which was well above the 5-year average of 11. So that was a big number. And at 26, it was the highest number of companies issuing guidance in the tech sector, dating all the way back to 2006. The old record was 21. And I use FactSet data, so that's as far back as it goes, since they started keeping track of that. So what was driving these positive EPS pre-announcements issued by the tech guys? Well, one factor was the unusually high number of companies issuing positive revenue guidance. Of the 28 companies in the IT sector that issued positive revenue guidance, that was well above the 5-year average of 17. Of the 26 companies that have issued positive earnings guidance, 21 issued also positive revenue guidance. One of the issues that has been driving the earnings guidance is lower tax rate, as most of them are saying that they're seeing a big increase or a big lower benefit from the lower tax rate. So that's April 6th. That's kind of the backdrop going in. Quarter ends March 31, right? So now we're kind of thinking, that's kind of how I'm thinking about the market. I go back and I review fourth quarter. I look at third quarter. April 6th comes along. April 13th, as of then, the S&P 500 was expected to report earnings growth of 17.3% for the first quarter. Now, that 17.3 is higher than the 14.8 that was issued in the fourth quarter. So what's the likelihood the index will report an actual earnings increase of 17.3%? Well, if you go back and look at the change in earnings growth due to companies reporting actual earnings above estimates, that number is likely to be, based on history, about 3 points higher. So on the 17.3% expected growth, you could, it's fair to assume you saw 20% growth. Over the past 5 years, on average, the actual earnings reported by the S&P have exceeded those estimates by about that much. Now, during this same period, 70% of the companies in the S&P have reported actual earnings above the mean earnings estimate on average. So as a result, from the end of the quarter through the end of the earnings season, the growth rate is typically increased 3 percentage points. Okay, so where are we? To date, 53% of the companies in the S&P 500 have reported actual results for Q1 18. In terms of earnings, more companies are reporting actual earnings above estimates. That's 99% compared to the 5-year average. Earnings are growing 23% year over year. That's huge. In the prior week, last week, or 2 weeks ago, because this is Tuesday, so the week before then, companies were reporting 18.5% earnings growth. But both of those, so it accelerated. The market's looking for 17.3%. The week prior to last, it was 18.5% companies were reporting. And then last week, 23% year over year earnings growth. So the numbers are wrong. The estimates were wrong, right? They were too low. Now, if 79% are the ones that are actually reporting above average, if that holds throughout the rest of earnings season, it's going to mark the highest percentage of S&P 500 companies reporting earnings above estimates since FactSet started tracking that back in the third quarter of 2008. In aggregate, the companies reporting earnings 9.1 above the estimates, well above the 5-year average. In terms of sales, more companies, 74% of them, are reporting actual sales above estimates compared to the 5-year average. In aggregate, the companies are reporting sales that are 1.7% above estimates, also above the 5-year average. Now, if that holds for the quarter, it's going to mark the largest revenue surprise since FactSet began tracking back to Q3 18. The blended year-over-year actual sales growth rate for the quarter is almost 8.5%. Last week, that was 7.6%. Right, so positive revenue surprises being reported by companies in multiple sectors driving revenue growth. 10 sectors are reporting year-over-year growth in revenues. 3 sectors are reporting double-digit growth in revenues: energy, materials, and tech. Yet stocks finished down. The S&P 500 was slightly down last week after blowout earnings. The S&P is at 2669, which is 4% below the level at the end of last quarter's earnings season. It was sitting at 2786, despite sales and earnings way above estimates. Blowout earnings. Fourth quarter, earnings came in above estimates, revenue above estimates. Today, as we sit, revenue and earnings blowing out estimates. But the S&P is 4% below the prior peak in January. At the end of January 26th, I think it was, 28th, something like that. Think about that. So where does the market go next? Right? Where's the puck going? I don't know the answer, right? But I do know how to look at the clues. And the clues are telling me that something is percolating underneath in the psyche of the market. Something is causing very strong earnings and revenue to not impress Mr. Market. It has to be, because the S&P is sitting 4% lower, right? And you don't need to be bombastic in your thinking. It doesn't mean the market's going to implode. It doesn't mean the market's going to crash, right? I listen to some of these newsletter writers, these guys on TV that market's going to implode. Who knows? I have no idea. Nobody knows. Okay, twin deficits. Got it. Check. Yeah, we know that. Consumers slowing. Yep. Got it. Know that. Thank you. GDP growth just came in, right? 2.3%, I think, for the first quarter, and it showed that the consumer slowed, business spending a little bit. Okay, the consumer's 70% of the market. If you follow my work, I mentioned it on a few podcasts. If you subscribe to my newsletter, you hear me talk about some of my concerns with the consumer. Consumer's a much bigger portion of the economy than the business spending. But what's occurred, right? If we think about it, we've had a lot of good news. Right? If you think back to, I think it was November, you saw the market go on a tear. Well, tax reform, right? Repatriation, lower tax rates, going to drive earnings. Got it. Check. Got that. Yep. Denuclearization of the Korean Peninsula is now starting, right? Trade war talk is subsiding. So geopolitically, maybe a little bit more stable. Earnings, well, tax reform is driving the earnings growth, right? So share buybacks and check, check, check. We're seeing all that. Stocks are lower, right? So so now I have to ask myself, what takes stocks higher from here? What is the next thing? What's the new thing that people that are going to get excited about? I think the onus is on the bulls to prove that at this level. Now, that doesn't mean you go out and sell every stock you own. It doesn't mean that you go out and short everything. What it does mean is you start to think about how to position your portfolio. It means starting to think about the risk on versus risk off. And you've heard me talk about this. I don't want to beat a dead horse, right? But it's been risk off for a long time. Risk assets have been in vogue. Well, if think about how your portfolio is positioned. Maybe do you have a few extra of those in the portfolio that have had huge moves? Maybe you want to think about lightening up on them. I think that's important. One of the things people say, I don't want to sell, I don't want to pay taxes. I never think about taxes. People think about not wanting to sell because of taxes. Well, if that stock gets cut in half, don't worry about it. Don't worry about your tax burden. Right. So I never make my investment decisions based on taxes. Now, I'm sure financial planners will jump up and down and say, we got to consider taxes. Okay. My experience has been measure risk reward, measure your upside versus your downside. And if you think that you are in every position, every day that you are investing, every day that stock or a bond, it has to earn the right to be in your portfolio. And it has to earn the right to be in your portfolio based upon the risk reward and the environment. Risk on, okay, take a little more risk. Maybe shift a little bit of your assets into the riskier assets. If you could sleep well at night, that's great. Risk off, meaning you're starting to see things that are challenging. Start to think about it. Here's another thing that's on my mind. It's kind of I want to talk about. It is the 3% rate, the 10-year Treasury, the global benchmark bond. Everything looks at it. Things, assets or interest rates are priced off that. Mortgage rates, car rates, credit cards. And I've seen some people out there saying, well, it's so the most talked about. 3% is the most talked about. So who cares, right? Why 3? When you get to 3, it's still dramatically lower than it has been. It's been much, much higher in the past. So 3% is an arbitrary line, and it doesn't mean anything, and stocks are not going to react right. Normally, rising interest rates can pressure the stock prices. People can rotate their assets back into more certainty in the fixed income market. And people argue, well, 3% is still really low on an absolute basis. That's great. I think that's such a flawed logic. And let me share with you why. Because people live in the real world and they live in the world of rates of change, right? So if you didn't own a mortgage when mortgage rates were 10% or 12% or 8%, whatever they were, or if you didn't have a car loan or a credit card that adjusted back then, you didn't have it. But if you now own debt, if you have debt and it has a variable side to it, when rates go up and it adjusts mortgages higher, that hurts. If your credit card debt adjusts higher, that hurts. If you're a company like 40% in the Russell, in the Russell 2000, if you're like 40% of them with variable rate interest debt, and you've been paying interest at X because your interest rates were Y, when the rate of change goes higher over the course of a year or 2 years, and you have to now go out and borrow more money, or it adjusts higher because it's tied to a floating rate, that hurts. Because the people who own your stocks, that interest expense is going to hit what those current earnings expectations are. Investors aren't saying, well, yeah, I know, but in theory, it's really 3%, and it was 6% at some other time. So let's give these chaps a pass. It's not the way it works, right? Wall Street, you want a friend, buy a dog. Nobody cares about where it was. They care about where it's going. And so if the rate of change is going up, whether it's earnings, interest rates, focus on rate of change, not absolute levels. And if the rate of change is accelerating and it's going to impact the interest expense of companies or the out-of-pocket expenses on a monthly basis for families, that matters. So when I think about stock prices, right, I think about rising interest rates. I think about higher interest expenses that it could be coming to companies. We've had all this great news, and stocks aren't going higher, right? So just put that into your thought process. So today's show. Oh, before I get to that, I want one more thing. I don't normally do this, but we're going to do a mailbag. I get a lot of emails. Like I said, I try and work through them as best I can, but some of them come in 8, 10 paragraphs long, and I try and get back to them as many as I can. One stood out to me. I think it was Wednesday night. I was watching late night hockey, playoff hockey. God, you know how I feel about playoff hockey. I couldn't be happier. And I get an email in between periods, and what caught my attention was the 3 question marks at the end. So Thomas wrote in, and he said, "You said that uranium bear was uninformed, yet you never summarized his arguments. Why not present both sides of the investment? Question mark, question mark, question mark." Now, 3 question marks get my attention. And, in hockey, I'm a grinder. I'm a corners guy. I'm not a finesse guy. And, so I don't back down to many challenges. And I was enjoying myself watching a hockey game, and 3 question marks from somebody without a hello, without a how are you, without I appreciate you doing a podcast for free and sharing your time. Just I thought it was a little bit aggressive. So I come back as the way I know. And we had some back and forth, and it actually turned out that Thomas is a nice guy, and we had a really nice exchange back and forth. We evolved into that. But I said, you know what? I'm not going to tell you now, but I'm going to address that on the podcast. And he was very gracious. He wound up being I enjoyed our exchange, and I need to learn. I respond better to people who have an introduction to their email, tell me who they are, what their concern is or question. I respond much better to that than I do somebody coming who I don't know coming aggressively at me. But that's neither here nor there. So let's talk about this. On the podcast I was interviewing Adam Rodman a few weeks ago, a fellow uranium bull, and he and I had been on the phone with a large hedge fund manager. And we will, of course, I will not name the name. And it was positioned as such that this guy knew a lot about uranium, and that we should talk to him. And a friend of ours, Adam and I, had arranged it. We said, sure, love to hear the bear case. We don't own the market on answers, and maybe we could be persuaded. Always looking to be persuaded. So. And we were told that it was a very informed view. And during my interview with Adam, I had mentioned, I said, yeah, you and I had spoken to a guy who had an uninformed view. And I let it go like that. So in the back and forth with Thomas, he had said, well, it seemed as though you were hiding something. I speak publicly on uranium. If you want, you go to YouTube, you see Mike Alkin uranium. You could see there's 30,000 people have seen this one, 10 another. I mean, I'm very public with the bear case. I lay it out in a presentation for all the world to see. But Thomas brought up a great point. When I said that to him, he said, I don't know that. I'm a listener for the first time. And he was right. Not everyone knows that I speak a lot publicly, that my profile in uranium is decently high. And so he was absolutely right. So I felt as so what I used as a throwaway line, we spoke to an uninformed guy because he was uninformed. And I thought that Thomas doesn't know that, and I'm sure there are other listeners who don't know that. So let me talk about what I meant by this hedge fund manager who had an uninformed view. So we started the conversation, and he said that the enricher capacity is dramatically underutilized, and underfeeding, right? So I'm not going to get into a uranium discussion here, but it's part of the secondary supply, and it's been a big reason for the overhang. And so we said, well, how do you think? I asked him, what's your estimate of capacity of underutilized capacity in the enrichment plants? And he said at least half. Now, so that was the beginning of the conversation. And I knew this conversation was going to go downhill because in the there's 55 million units of separative work units of supply and about 48 million in demand. Like I said, I know uranium, and I spend a lot of my time doing due diligence in the uranium space. So whether you can say it's 46, 49, 45, okay, but maybe I'll take that. To tell me it's half, you don't know what you're talking about. Okay, so you're not even close. So, and he pulled that number. I could tell he pulled that number out of you know where. And then we were talking about supply and demand. And Adam and I were chatting with him, and the way that I and Adam and others who focus on this industry do our supply and demand analysis is you look at every mine in the world and you lay it out on a spreadsheet and you look at what they're producing and you look at what their utilization rates are. You do the best you can to understand that. You try and understand what the decline curves are the best you can to understand that. And then you look at every reactor in the world. And then you look at every prospective reactor in the world that could be closed down wherever countries are talking about closing nuclear power, and you make an estimate on when that's going to close. And then you could look at every prospective mine in the world, which is what we do, and the economics required to build those mines and where they are in the stage of permitting and licensing and what uranium price is required to go into production. And then you could look at every prospective mine or a prospective reactor that's in planning and development. You could choose to include those in your estimates of demand or not. We choose not to because you just don't know. We choose to use what we know, and that's construction. You've got to look at inventory. You've got to understand all the sources of secondary supply. He had none of it. And when we spoke to him about this, what was his response? Well, we can agree to disagree on that. No, we can't. I can't have a logical argument with you if you don't come to the table with the numbers. Then we talked about the Kazakhstan transfer laws. Right, one of the things I brought up speaking back in June at the Vancouver Resource Investment Conference in June of last year. I laid it out in the presentation. Transfer laws in Kazakhstan prohibit you from pulling it out of the ground and selling it to anything but other than the spot market. And we talked about the marketing arm that was being set up for the Kazakhs to be able to do that. They were setting up a new trading arm in Switzerland. He was unaware of either, and when told about them, within about 2 minutes, he told us it was not meaningful. It didn't matter. Then we talked about Section 232, which is the petition of the Commerce Department by two uranium miners, Energy Fuels and UR Energy, to require the U.S. utilities to purchase 25% of their uranium from the U.S. producers. Didn't matter, I was told. We were told. And then he had said that Cameco has been in the market buying uranium. It's had no impact on spot, so there's so much inventory out there. Now, based on our due diligence, we didn't think Cameco, if at all, had been in the market. If they had, it would have been very tiny. Now, they're going to need to buy a lot of uranium because they shut down the world's largest mine. And we were told that they had. That he told us that they were, and it's had no impact, and that's proof of it. Now, I've been in the hedge fund business a long time. And if I had a nickel for every cocksure, arrogant hedge fund manager that I know and deal with, I'd have a lot of nickels. Now, I also have a lot of good friends in the industry. But the humble guy who can be wrong is more the exception than the rule. Cameco reported their earnings on Friday and came out and said, basically, we've not even really been in the market at all. But we will be. We're coming. That and others is for those who, when I said misinformed, if you thought it was a throwaway line or I didn't want to present the second part of the case, there you have it. I don't, like I said, I don't own all the answers on uranium. Adam would tell you the same thing. I think I'm right. We've done a lot of work on it. I think my thesis is right, but I could be wrong. I've been wrong before. I want to hear where I could be wrong, but I want it to come from an informed view. So that's that. So let's turn to the interviews. Now, this is going to be long. It's 2 parts. You could listen to the first part, listen to it when you want. I'm not telling you how to listen to it, but settle in or go to Curzio Research, download the transcript. It'll probably be available in a day or two, or listen to it at your leisure. But my first guest is a friend of mine named Chad Cascadden. And Chad was a Wisconsin high school athlete, born and raised in Chippewa Falls, Wisconsin, and played football there. And then he blew out his knee, and I think it was his junior or senior season, and all the offers for scholarships went away. And then he got an offer to walk on at the University of Wisconsin, which was being led by then now legendary Barry Alvarez, but Barry had just started at the University of Wisconsin. And Chad walked on, and after a few years, became a starting safety, and then he wound up becoming a linebacker with a 4.4 speed. And those of you who understand speed, 4.45 speed or something like that. I mean, he's a flyer. But he went undrafted, and he wound up getting asked to after the draft to be a free agent walk-on, and he tried that, and he got picked up by the Jets, and he had a career 5 or 6 years. And I've known Chad for a lot of years, and one of the things he played for Bill Belichick, he played for Bill Parcells. In talking to him over the years, there were so many times we'd be sitting having a beer, and a light bulb would go off for me that what he did, what he learned, the lessons he learned are so applicable to investing. And with the draft that just came up, I thought we'd get him on. We'd talk a little bit about the draft, but we'd talk about, a little bit about his football experience, and then we're going to translate into that and how it applies to investing. So if you're not a sports fan, or you're just not that excited about hearing something like that, you could go to the next guest, which will be Rob McArthur. And Rob is a friend of mine who I've known over 20 years, and he is a professional short seller. And he does tremendously deep industry and company research, stuff that you will never see from the sell side, from the research houses. It doesn't happen. I've been a short seller for 20 plus years, and when you're against companies, you better do really good analysis and dive deep. And Rob has found some fabulous frauds in his career. And he has also just found regular companies that he thinks are stumbling. And so I thought it'd be good for you to hear how a short seller goes about thinking about finding companies and what they do when they find them that can be problematic. And if you have it in your portfolio, or if things for you to look at as you're thinking about investing, you're buying stocks, right? Because if you're listening to this podcast, I hope you're not that guy who buys stock tips, right? Or one of these BS newsletters that are out there, talking about that, or wherever you get your ideas, the hot stock, the tip of the day, right? No. Hopefully you're doing real research. And if you are, hopefully this makes you a better investor. So with that, I will welcome Chad Cascadden. Chad, welcome to the podcast.
Mike Elkin, thanks for having me.
So you and I have known each other. I'm just trying to think about that this morning. You and I have known each other for about 12 years, and we live in the same town. And we became buddies pretty early on. We both had things that we like about the other. I'm a huge football fan. I played quarterback in high school, and I just, if I was just 4 inches taller, ran a second faster, and all that other stuff that I didn't have. And you were an NFL linebacker for a number of years. You played for some great coaches, and a great story, which we're going to talk about. And I'm in the hedge fund business, and when you and I met, and that was something that really fascinated you. So we both had a lot to talk about when we first met. But thanks for joining. And Chad, I when I think about as I got to know you and where you came from, where you are now, it's fantastic. A highly prized high school football player in the state of Wisconsin that blew your knee out and kind of set the course for the rest of your life almost, where it led you to have to become a walk-on player at the University of Wisconsin after being highly recruited before that, and then proving yourself there, and then getting undrafted in the NFL, and then having to prove yourself there and becoming special teams rookie of the year. And, why don't you share with the audience, tell us about your background, and it translates so much into regular life, folks. It's really interesting. So Chad, why don't you give us a little bit of background?
Yeah, thanks, Mike. And, isn't it funny how one little thing in your life can set the course for the rest of it and create a theme almost. And when you look back at it, at the time, it was, when I blew my knee out in high school, I thought that was the worst thing possibly, but looking back at it, perhaps it was the best thing possible. So, yeah, I grew up in a small town in Chippewa Falls, Wisconsin, about 12,000 people within the size of Nassau County here in Long Island. So very spread out, lots of farms, lots of corn and cows. And, I sort of grew up where your bike was your freedom. I would bike everywhere. I biked to school. I biked a friend's house. There was no Twitter and Facebook and Instagram and,
sure.
Xbox 360. So
there's bicycles and cow tipping, right?
Yeah. Hey, look, there's not a lot going on out there. So you got to make your own fun. And that we had some fun. That was for sure.
Yeah.
But, biking and doing all that physical activity it sort of shaped me into what I was as an athlete. And I was a very good baseball player. And I was a good runner. I was fast and I could play a lot of different sports. I played tennis, track and field, basketball. I was actually a really, really good swimmer, and did very well in swimming, and actually was offered scholarship to go to college to swim, which I declined because swimming, in my personal opinion, is one of the hardest things on the planet. It is just
it's grueling. Yeah, it's exhausting.
Well, it's also not as fun as football. And really, Mike, truth be told, I didn't start playing football until I was a sophomore in high school. I was, 16. I went to a small private school. We didn't have football. And when I was in ninth grade, I ended up moving into the public school system and really had to find myself and figure myself out. And then in my sophomore year, I went to the coach and said, "Hey, I think I want to play football. Can I try out?" And so that sort of led me on the path of being a football player. And then my senior year in high school, I ended up blowing my knee out. My first game of the season, I had a lot of interest from teams. And, after you see a young kid like me blow his knee out, well, the scholarship offers are just not there.
Sure.
And so being in state and from humble beginnings, I had very good grades and I applied to a number of different schools, but the University of Wisconsin, the state school, I really, really enjoyed the campus. And when I was, when I was accepted there, that was my first choice and I wanted to go there. And so I accepted the offer to go there. And then I got a call from Barry Alvarez, who had just taken over the program coming from the national champion Notre Dame Fighting Irish.
Yeah.
And said, I don't have a scholarship for you now. I'm building a walk-on program here. I want you to be part of something. I think it's going to be pretty awesome. And if you'll put in the work and you'll put in the time, I'll do my best to coach you. And, I took that as a sign of he wanted me there. And so I said, yeah, you know what, I'll give it a shot. And boy, did we ever. And, after 3 years of being there, we turned the program around. We won a Rose Bowl. In the fourth year, we won a Hall of Fame Bowl, which is now the Outback Bowl. And, I ended up graduating with a degree in kinesiology. And I was a good player in college. But truth be told, I really never thought good enough to make that next step into the NFL. But the opportunity came.
So here we had the draft. And my God, you talk about Twitter, Facebook, Instagram. We didn't have that as kids growing up. We certainly didn't have the hype that leads up to the draft that we've seen. It's been since the end of the Super Bowl, all you see is the talk about the quarterbacks, Josh Rosen, Sam Darnold, Josh Allen, Baker Mayfield. Who's it going to be? Is it going to be Saquon Barkley? It's every day, 24/7, if you follow sports. Some people don't, and I'm sure some of the people on this podcast might be fast forwarding because they don't care about the sports portion of it, but many do. But it was just, it's everywhere. And we saw the road leading up to the combine, and the combine, the cameras take you into the combine, and then they highlight certain players and what it's like. And a lot of hype around it. But when you were playing, it wasn't like that. And here you were not even part of that. So how does a guy from Chippewa Falls, Wisconsin, that is a walk-on football player, that turns out to be pretty darn good, how do you make that next step? What drove you to say, you know what, I think I could do this and play on Sundays? How did that transpire?
I'd like to say to you, Mike, that I had a vision in my head, that I knew I was going to make it, that I had dreamed about it my whole life, and I was going to go and get it. Well, it's absolutely not what happened. I improved every year while in college.
What was your 40?
Well, I'll come to that. Let me just paint a picture for you. So every year I improved, and when I went to the University of Wisconsin, I was a 6'2", 200-pound safety, and so I played safety, and I was third string for the first couple of years, and I just kind of looked at my situation, and I said, I'm not going to be able to crack the starting lineup here at Wisconsin at safety. And I was getting bigger and I was getting stronger every year, probably putting 5 to 10 pounds of muscle on every year. And by the third year into my career, now mind you, I was redshirted my first year, so I went to 5 years of college at Wisconsin. Mm-hmm. So by my third year, I'm 20, I'm 225. I'm getting faster and stronger. And I went to the coach and I said, I think I want to try to switch positions and move to the linebacking room and maybe play linebacker. And so the coach agreed to let me do that. And I started learning linebacker, and I learned how to play Sam, and I learned how to play Will and Jack and Rush. And, I got to get really good at playing all these different positions. And then as time went on, again, I got faster and I got better, and I got reps, and, I sort of became, and I listened to your podcasts, how you speak about being a generalist. Yeah. I sort of became a generalist on defense and special teams. So really, wherever I needed to be put, wherever we needed someone who had my skill set, they could put me there, whether it's at Sam or Rush or Mike or Will, or even defensive end on nickel and dime, or I could play strong safety in short yardage. So suddenly I sort of developed this niche of being, sort of this Swiss Army knife. Right. And so when I got to my senior year, to answer the question, we had a pro day at Wisconsin. I was not invited to the combine, but we had a pro day, and every scout from the NFL was at our pro day. And the first thing that they do when they all get there is they all of us guys that want to take a shot at maybe just working out for a team, the first thing they do is they make you run the 40. And so I ran the 40. And I ran it so fast. I ran a 4.46 40 at 6'2", 235 pounds, that they made me run it again because they needed to verify it.
I mean, that's wide receiver fast. Yeah.
Yeah. It's kind of stunned them. Now, mind you, Wisconsin has got a reputation of being a tremendous football program now. Well, back then it wasn't. So people were kind of surprised to see this type of athlete come out. And as you'll maybe or maybe not remember, linebackers, a 6'2", 235-pound linebacker back then in 1995 was not what they were looking for. Right. They wanted a 6'4", 250 thumper.
Yep.
Well, that wasn't me. And so, I ended up just saying, all right, well, I think I got a chance here maybe. And on draft day, I was not drafted. But right after the 7th round, I did get some phone calls, and ultimately I chose to end up going to the New York Jets. They had a new coach, Rich Kotite. Mm-hmm. They didn't have very many linebackers on the roster, and I was just looking for a place for a chance to play, because what I learned was it doesn't matter if you go there and you do really well in practice and you do all these things in the film room. At the end of the day, it's a business.
Right.
And much like being a hedge fund manager, it's about the returns. You have to produce. And on the NFL, you got to get film. And if you're not out there, they don't care. They don't see you. And the way you get out there is you got to go on a team that's going to put you out there.
Right.
And so I thought the Jets had the best shot for me. And fortunately, I was correct. And that's sort of how I made my way into the NFL. It was not planned out. It was not a vision I had in my head. It just much like my whole life, it just kind of happened.
So you wound up, so your rookie year played a lot of special teams, and then you went on to, tell us about that progression and how you're learning. And I equate it's very similar to in investing, really, if you will, when I think about it, because it's football. While people think it's just a brute strength game, it's a very cerebral game. And you mentioned earlier being a generalist, if you will, learning the different positions. One of the things that I talk about, like you said on the podcast, is I think specialization really pigeonholes you, and sometimes you can't see the bigger picture. So now you come into an NFL training camp, and you're really kind of a generalist as a special teams player. Talk about what that transition was like from going to play one thing to now having to learn a whole bunch of different stuff.
Yeah, and that's a good question, because I think a lot of people sometimes are confused when they see a really, really good college athlete go into the NFL and sort of flame out and sort of not make it. And it's like, what happened? And I'll tell you, a lot of it has to do with the speed of the game. The speed of the game in the NFL is at a completely different level than it is in college. Everyone is fast in the NFL. In college, most of the time, you've got one or two, maybe three really, really fast guys on your team. They're flyers. In the NFL, everybody at every position is a flyer. They are big, fast, and strong. But also, the mental game is a lot faster. And there are times where reaction isn't fast enough in the NFL. You have to anticipate it. You have to see it before it happens. And that's where that film room and that time studying and looking and asking questions, and am I right here? Am I wrong here? And if I see this person do this, what is there a trend that comes from that? And we did this. I would do this every week. Now, the first year that I played, I ended up making the roster, and a gentleman ended up getting cut that was a favorite of the defensive coordinator, who was my linebacker coach, Jim Victorella. And Jim came to me and he said, "You'll never play a down of defense for me ever." So there you go. That's my first year. Welcome to the NFL, kid. You're never playing defense for me ever. So I just poured my entire efforts into practice and special teams. And when I played, special teams were special teams, kickoffs were kickoffs. I mean, it was a violent car wreck every time. And I did very well. I was very good at it. But by my second year, we'd have problems on defense. We didn't have a pass rusher, opposite of our really good pass rusher, Hugh Douglas. And I went to the coach and said, "Look, I did this in college. I know I may not look like it, but I can do this." And the first week, we ended up not getting any pressure. The second week, we didn't get any pressure. The third week, we're playing Jacksonville, down in Jacksonville, and the defensive line coach, calls me over during practice, and he says, "You can pass rush," he said, right? And I said, "Yeah, I can pass rush." He goes, "Okay, let me see what you got." And I had to go against Jumbo Elliott, who's
another Long Island guy, I might add.
Yeah, who's 6'6", 320 pounds, out of Michigan, and considered, one of the best left tackles of the time. So I ended up going against him a couple of times, and I actually did very well against him. And the next thing I know, I'm the starting nickel backer at left D end against the Jacksonville Jaguars. And on the first play that I was out there against Jacksonville, I ended up sacking Mark Brunell. And on the second play, I ended up forcing a bad throw. And on the third play, I got him again. So all of a sudden, it's like, wow, we've got this, this white kid from Wisconsin that we had no idea that he could play like this.
And run like this.
And so suddenly I went from being a special teams player to a special teams player and a defensive end. And by the 8th game, I'm the starting will backer. So now I'm the will backer, the D end. I'm the strong safety on short yardage goal line. I'm on all the special teams. I mean, I'm literally, I don't come off the field except for first, second, third down offense. That's it. I mean,
so you're a generalist.
So I was a generalist.
And you said something earlier though. I don't mean to cut you off, but it's fascinating as you were describing what it's like in the film room and looking for tendencies and looking for things that can tip you off to what they're going to be doing in terms of anticipating the play. That is investing. What you just described, what you were describing, it is so often it's analysis, and that is how I try and share with the listeners. If you're doing research on a company, it's not about the headlines. It's not about buying what which years ago was just go buy what you know. If you shop there, it's good. It's more than that. It's looking at trends, right? So from a financial analyst perspective, when I look at a company, it's nice to know what they're doing today and in the future, but I want to go back and look at 10 years worth of tape, if you will, like you would look at in the film room. I'm looking at 10 years worth of financial history to understand the trends and the tendencies of this business, right? Because so much is cyclical, and I'm looking for different peaks and troughs and how does it play in certain economic environments, and what happens when raw material costs are going. That's no different than what you're doing at that time, or what you were doing as a linebacker in the film room.
It's exactly the same, and I would go so far as to say I enjoy your handle footnotes first, because when you watch film, you see the play, you see the motion, you see the the different formations, the down, the distance, how much time's left in the game, are you ahead, are you behind? But what you really start to do as time goes on is that stuff becomes normalized. Then you start really digging into the super duper details and getting really deep into the footnotes and starting to watch tendencies. Let me give an example. So Dan Marino, for a very long time for the New York Jets, was a thorn in the Jets side. And since that 1994 fake spike game, the Jets had always just struggled against Dan Marino. Dan was an amazing quarterback. The man had the quickest release I'd ever seen. He had just an unbelievable canniness to reading defense. He knew what was coming, and we just had a ton of trouble getting to him and putting pressure on him. So I was in the film room one time, and I went back probably 3 years, and I just went over every game, and I'm watching Marino trying to come up with something that can tip me off with a tendency. And I eventually found it, and you're not going to believe what it was. I mean, so when as he got older, he got a little stiffer, and he blew his Achilles tendon one year. So he had to wear this.
He couldn't move as a rookie. So I could only imagine.
No, he was not the most mobile quarterback I've ever seen in my life. Yeah. No,
great quarterback.
But as he got older, he had all these different pads on. He had hip pads, tail pads. Yeah. He had this big boot that he would wear. It looked like a shoe, but it was really a boot to protect his Achilles. He wore knee braces. He wore rib guards. But he had a tendency under center to sway. As he got older, he'd sway back and forth. And if you watched his feet, his toes would come off the ground. But when he was about to hike the ball, because as a quarterback, you can't move before you hike the ball, he would settle his feet. And if in your brain you would count to 1001, the ball would snap. So now I'm getting off on the ball just a little faster because I know the ball is being snapped. Sure. Because I've seen it now. I've seen 13 games of this, and it works every single time. So I took it into Belichick, and I said, Coach, I know this is crazy, but I said, I think I found something. And I ended up showing it to him, and he ended up showing it to the team. And the next week when we played Miami, we ended up sacking Marino 6 times that game. And we ended up winning the game, of course.
And by watching his toes.
But I didn't know to watch for it. I was just trying to discover something. So I was digging into the footnotes, and I was going deep, deep, deep into the weeds, just trying to find something that would tip me off. And that was the tip off.
Chad, that's fantastic. And that's why I do this podcast, right? Because I try and level the playing field for what professional investors do day in and day out, and I try and level the playing field for the ordinary investor. And here's the thing. When you watch the CNBCs of the world or the Bloombergs and you see these people come on and interviewed, there's a lot of jargon that's used, a lot of acronyms that are used, and there's industry talk, Wall Street, stock talk, right? But at the end of the day, being a good investor is really fourth grade math. If you could add, subtract, multiply, and divide, you're good. That's a good starting point,
sure.
Right? And then if you're curious and you understand what to look for, then it's the playing field is level, right? It's just knowing, it's sitting in that film room, it's reading annual reports, and people listening to this podcast, if you're listening to Mike Alkin in a financial podcast, you've got to have an interest in investing, because there's a lot of more interesting stuff than listening to me. But the parallels are really amazing, and I tell people, there's no secret sauce. People ask, well, what is it? What's the one thing you look for? Oh my gosh, it's a blank canvas. I mean, I put together over my career 185, 200, I forget what it is on the checklist, and the things that I look for. And you know how that checklist builds, Chad, and it continues to build by the mistakes that I make, because you don't have all the answers, So when I first started and I was working for the legendary Joe Domena, you're given kind of a playbook on how to think about the art of it and how to understand the psychology and understand that the markets are full of people with human emotion, and that's tremendous. And then as you go on and you experience things, the best learning experiences are from the biggest mistakes that you make. And then, boy, you make that mistake once, you're probably not going to make it again. Check, put it down, right? And the same thing when I think about that, it's similar to playing football. If you get burnt on a coverage, you're going to remember that. I remember I was a safety in high school and a quarterback, and when I would throw a interception, or somebody would get behind me in coverage, Greg Mousehart, my high school football coach, used to say, "Fool me once, shame on you," meaning the other guy, good job. Fool me once, shame on me. Meaning if you don't learn from that mistake, that's your own fault. And so you realize that you have to learn, you have to do postmortems, and that sounds very similar to what you did for your career.
Well, my first 2 years with the Jets, we did a lot of postmortems, and it was awful. And when we finally had Bill Parcells and Bill Belichick come in, obviously it changed a little bit. But even still, if we watched a play where, most of the guys did what they were supposed to do, we wouldn't spend a whole lot of time on that play because, hey, you did what you're supposed to do. You're paid to be successful. Right. We would go to the plays that didn't work, or we would go to a play where maybe a guy had a bad hand placement or a bad foot placement, or maybe his angle was incorrect, and we would spend an absorbent amount of time of, here's what went wrong, here's why it was wrong, here's what happens when you do it wrong, and this is how we fix it. And then Absolutely. We'll go outside, and now we're going to walk through it just to make sure that it's in your head and okay. Then let's not repeat these mistakes. And I know this sounds crazy, but a lot of the things that Belichick would teach us aren't necessary. I mean, they are what you're supposed to do, but it was really avoiding what you shouldn't do, and really avoiding, don't turn the ball over. Don't do a stupid penalty like jumping off sides, or grab
eliminate the easy stuff, right?
Eliminate the easy things that cause you problems, and then be situationally aware. Know what the down and distance is. Know how much time is left on the clock. Know what the points are. Understand, and make sure everyone is on the same page and communicate. And it's extremely similar to success in the real world, because all of this, on Sunday when you watch it, it looks sexy and the pageantry is awesome and it's really exciting, and it is, but you don't see the grind.
Right.
And you don't see the behind the scenes, and you don't see the taking care of your body and eating well and getting your sleep and, having to stay in on a Friday night when everybody's out having fun because you've got to catch up and you've got to watch film and you've got to sleep and you need to take care of yourself. Nobody sees that. That's what happens.
Yeah, it's interesting. One of the things that as a big football fan and something is situational awareness, right? And I think about investing and situational awareness in football. If I think about it, there are times understanding where you are in the game. So if there are times where you might need you're down by a touchdown with 3 minutes to go and you need to be more aggressive. Maybe you're sending an all-out blitz when you're exposing yourself to a pass downfield, but you need to get to the quarterback. It's that situation calls for it, right? Investing's the same. I often get asked, how much should I put in this one stock? Or when I speak to individual investors, sometimes friends of mine or just people out there, they'll say, I like this stock. Now, this stock might be incredibly speculative, and it might have the potential to be 100 times upside, but the chances are you don't see that type of opportunity unless there's real risk to the downside. So if you're situationally aware that, okay, if all the things that need to go right, I could have a 50 times return, 100 times return, but you need to know what your downside is. And if you know that your downside, there's a high probability that stock could go to zero, that's okay. It doesn't mean you can't invest in it, but what it means is be situationally aware as to what role it plays in your portfolio and does it allow you to sleep okay at night. So if you think you have a 10, 20, 50, 100 bagger, maybe it's a 0.5% position or a 1% position, whatever is comfortable for the person. And if it works, if you had a 1% position of your portfolio that went up 10 times, well, that's 10 percentage points of performance. But it's good to be aware of the risks and the reward and what situation it is and what role it serves in your portfolio. Conversely, there could be a stock that has 30% upside and maybe 5% downside. Well, maybe somebody might consider that as a 10% position in their portfolio because the risk reward is different, whatever that number is and whatever their comfort level is. But it's knowing it's putting things in context and having a playbook. And it's very similar to what you spent 6 years doing in the NFL.
Yeah. So I'll just take a real quick story about that, just how that dovetails nicely. When playing for Belichick, we would bring blitzes every so often. And, a lot of people know Belichick as, a master at his craft when it came to defense. We would find ourselves in situations against a team where if it was 3rd and 6 and we were on our right-hand hash mark and they came out in a certain personnel group, that we were going to bring an all-out blitz from the field side. And the reason why we could do that is because if we bring an all-out blitz from the field side, which means the center is going opposite, which means we're going to run that blitz over the running back, which means we're going to get a free guy in the quarterback's face, which means the quarterback's got about a second and a quarter to recognize it and get rid of the ball, which means the receiver is going to have to cut his route off and run on it, which means even if the quarterback gets the ball off, which probably won't, and even if the receiver catches the ball, which it's possibly will, he's still only 3 yards down the field, and then we make a tackle for a 4 or 5 yard gain, and guess what? It's 4th and 1, and they have to punt it.
Yeah.
And so that is that situational awareness. Why should I take the risk? Look, if all the things line up appropriately, then take the risk. But look, is it possible they might get 6 yards or 7 yards? Yeah, but it's a calculated gamble.
That's it.
And the upside is really good, and the downside's protected. So
it's probability analysis, right?
It's exactly right.
That's right. And so it translates in the NFL sidelines and it translates into investing. And I think, and like you said, what you were saying about Marino was you're watching film and you're looking for tendencies and you didn't know what you were looking for. That's how I look for my ideas and my investments. So whether they're longs or shorts, you have experience and you kind of have a gut that tells you what to look for, but you go in with an open mind. And when I do that, I have that mental playbook, that mental checklist that I'm looking for, but every company's different. So for me, it's looking at 10 years of historical financials and staring at them and looking at ratios. It could be what the gross margin trend has been, the operating margin trend. What has been the growth in sales versus the growth in operating income versus the growth in gross margin? Does it have the ability to scale? The more sales they get, does that translate into higher profits? You should have more. If you have higher profit growth than sales growth, you got scale, right? When I'm looking at these companies, I go in with an open mind. I just say, let me see what I'm looking at, and the numbers tell the story, just like you watching film and the tendencies tell the story. So there really are some great parallels to draw. So with that in mind, so life after football, and how do you translate all the lessons you learn there into a professional career and what you do?
So, a lot of the things that we've been talking about, they really translate well into the business world. And really every business is extremely similar with regards to sort of these common core type of things. It's getting in, it's understanding the business. I can't tell you how much time I just grind and I read and I try to figure things out that I spent all this time on. And then I wouldn't say it's of no use, but it really didn't help me at that time. And it feels like, boy, that was a big waste of time. But I came out of football, I took a job with Morgan Stanley in August of 2001. Pretty unfortunate timing, obviously. September 2001 was a real rough time, and so I ended up being let go by Morgan Stanley. Just bad timing, unfortunately.
Yep.
And I got into the insurance business, and I spent a long time, I think a long time, in the insurance business, about 16 years, and up until this last year, I decided that I wanted to help raise money for hedge funds and private equity firms and things of that sort. So I with Mike, with some of your help and your suggestion, I've started to do that. And I take these lessons that I learned from playing at University of Wisconsin and playing on, in the NFL and in the insurance world. I take these lessons and I apply them to my life, not only at home, but at work. And it is, you got to get into the details. You got to understand what you're doing. You got to grind. You got to see trends. And then you try to help people around you. And, I have found that these types of traits have been successful for me. And I think, in the world of specialization, and I'm not saying that being a specialist is a bad thing, but for me, my success has come from being a generalist.
Well, I know you talk to organizations or companies, and you can go in and work with sales teams and whatever it may be to management teams. Well, I don't want to, I know it's proprietary for you, so I don't want you to give away your secret sauce when you're talking to these organizations about how to improve performance, how to become a better salesperson. What are some of the things when you go in, when you're brought in by these companies and organizations that you do? What's the message you give to people?
Well, being a salesperson it's very rewarding, but it's extremely challenging. And, sometimes you can feel alone. The word no is something that you get used to, and being you can get discouraged. It can be discouraging. So, I always try to encourage the sales forces out there to sort of, you've got to set up your life much like a football player. You've got to work out. You've got to eat right. You got to get the sleep down, because you're expected to perform every day. And when you're not at your peak every day, that's going to affect your sales. And then you have to have a process at sales, whether it's some sort of CRM or whether it's a Salesforce or whatever program you use, and you've got to work it. And that's the science of it. But then there's an art to it also. There's a certain periods of time during the year that people are more receptive. People are less receptive on Fridays. Usually it's somewhere Tuesday, Wednesday, Thursday is usually when people want to talk. Fridays, people are wrapping up their day. Mondays, they're trying to, get things going for the week. So you have to kind of pick your spots and your times a little bit more, strategically.
So you're looking for tendencies in when people are willing.
Exactly right. And then whoever you're going to sell to, what is it that they do for a living? How is it that you as a salesperson can help them? Is it an introduction to maybe a possible client for them? Are they looking for capital? Are they looking for an investor? Are they, how do they make money, and what kind of issues are they having problems with? And perhaps you can help, solve that problem for them too. And it really, you become more of a consultant and a friend than just, someone that's out selling a widget or
selling a service. It's amazing,
as
with my career in the hedge fund industry for so many years, and at a decision maker level for probably the last 10 years of my career at Big Fund, you get people who are trying to sell services or insights, analytical research to you. And so you take meetings with people, right? So a lot of it is spent doing research and investing, but there's the other part of the job too, where, you have to listen to people and they come in and they're trying to sell you something. And institutional salespeople who want to tell you why their brokerage firm has the best research or whatever it is, it has to be, and I'm making up a number, but I'm probably close. 9.5 out of 10 times, the person sitting across from me trying to sell me something goes right into their pitch, doesn't ask me a single question, doesn't ask me what my needs are, tells me what their product is, and asks for the sale. And they've got zero chance with me if they do that. Right. If they don't take the time to get to know me, to get what my needs are, to solve me and be consultative to me and solve a problem for me, forget it. Right. And it's amazing how many people are bad at it. It's stunning to me. Before I let you go, I need to pick your brain on, let's go the top 5 picks of the draft. I'm a diehard Jet fan. And right. So I see Sam Darnold. I'm still not sure how I feel about it, but so the Browns picked Baker Mayfield. Now, Baker Mayfield, I'm a huge fan of, and I'll tell you why. I came from a circuitous route to get to Wall Street. I wasn't an Ivy League educated guy. I didn't have great pedigree. My family was blue collar, just like yours. And so I got in the hallowed halls of the hedge fund industry by happenstance. And I got in there and greatly intimidated the early part of my career. And then all of a sudden I had that light bulb moment saying, you got to be kidding me. Seriously? Wow. I'm glad I didn't study that hard. I'm glad I didn't go to that school, because you know what? I know as much as they do. And you know what? Work my ass off, and I'm in the office 18 hours a day, and I'm on the road, and there's that light bulb moment, and you become a little almost you got to be outside the box. You got to think outside the box. And when nothing's handed to you, and you got to bust your ass, and you just stumbled into it. It makes you work hard. And I'm not saying that. Look, I worked with a lot of guys with great pedigree from great schools who work really, really hard, but it doesn't mean they're better. And I look at Baker Mayfield, who was a walk-on at Texas Tech, a walk-on at the University of Oklahoma. He's a little bit of a hothead on the sidelines, right? And so people look at him and say, oh, God, another Johnny Manziel. I look at it like, wow, this guy worked his ass off. He's hungry, and he's going to get it. And so versus like a Josh Rosen, who's sitting in the draft room last night, picked 9th by the Cardinals, and his first quote was, or picked 10th by the Cardinals, and his first quote was, 9 teams made a mistake. Oh, okay. Thanks, Josh. That real humble and gracious versus a guy like Baker Mayfield, who's out there saying, bring it on. And what are your thoughts?
It's interesting. I didn't know that Josh Rosen quote until actually one of my sons this morning said, did you hear what Josh Rosen said last night? And I sort of snickered when I heard it, because that's sort of how a lot of guys feel that way. And you know what? Good for him, to be honest, because now he's got a little chip on his shoulder. It feels like he got dissed a little bit. And, that sort of energy, you can take that and you can use that as a motivation to get better. What's interesting about Baker Mayfield, everybody talks about his height. He's 6 feet, maybe 6 feet and a half.
Almost 6'1".
Almost 6'1", but he had an incredible path to success. And if he were 6'4", I don't even think this would be a discussion. Right. It's that couple of inches. And, people are comparing him to Russell Wilson or, a Drew Brees. I don't know. But I do know that he's a winner. I know he has passion. And so for the Cleveland Browns, I think they saw it and they said, hey, this is a kid we can put in right now and we can win. And maybe they saw some of the other quarterbacks as they're good, but, maybe it's going to take some time. And, he's sort of, look where he's going. And I always find it interesting to see personalities versus the personality of the team they're going. And I got to tell you, I know a lot of people are down on the Cleveland Browns. The Cleveland Browns got a really good roster.
Yeah,
don't be so surprised if they're a good team next year. But that Baker Mayfield, hey, blue collar town, it's kind of cold in the winter. The Cleveland
kind of cold,
kind of tough, and if Sam Darnold, a USC pretty boy goes there, and I'm not suggesting he wouldn't have been successful there, but it almost doesn't match. You know what I'm saying?
I could not agree with you more, Chad.
So
absolutely. That was one of my concerns with Darnold coming to the Jets, actually, is yes, New York, LA, big cities, but hey, man, you played out what was called the Meadowlands when you played there, but it's now MetLife Stadium in Jersey where the Jets play, and it is staggeringly cold on certain occasions, and the wind is howling, and he's not played in that before. Nor is Baker, but Baker's a true grit kind of guy. Maybe Sam is, but yet to be seen.
I've seen games of both, and I'll be honest, I was happy when I saw the Giants pick Saquon Barkley. And look, I'm a New York fan. I'm happy for them. It says to me that they have committed to Eli Manning as their quarterback, and they're going to give him weapons. And Saquon, I think, he is the least bust potential of anybody. He's got all the numbers. You can see the film. He's gone against Big Ten talent, which means he knows what it's like to play against big boys.
Yep.
And that will translate well for the Giants, and it will translate for taking some pressure off Eli Manning, which will help him and help that offense for the Giants. So I'm happy for the Giants fans today. They got a really, really good player for it, for the foreseeable future.
So let me put you on the spot. Anyone you think's and you are also a TV analyst on the NFL for the NFL in New York, local sports for the Jets. Anyone you think is highly overrated or highly underrated? A surprise
in the entire draft or in the top
in the draft.
5?
No, in the draft. Anyone that just you stood out and go,
I didn't get to see a lot of film on Josh Allen, but he wasn't very accurate in college.
Yep.
And it's not often that you see a college quarterback come into the NFL and significantly improve their completion percentage. I want to say Josh's was like 56% or 55%.
Yep.
And really the sort of the borderline is 60. Like if you're not a 60 or above in college, you don't usually do very well in the pros. But when you look at it and look at the quarterback look at the head coach that's the Buffalo Bills, right? Offensive coordinator, bit of a quarterback guru kind of guy. And then look at Josh Allen. He's from Wyoming, kind of a cold, tough, middle America kind of place. And he's going to the Buffalo Bills, which is kind of a.
Yep. It matches personality wise.
So it matches. So perhaps that's the right place for a Josh Allen. But I'll be honest, there's a lot of names in that first round where I was just like, I don't even know who that is. coming from schools like Texas, San Antonio,
and
Boise State,
and
Central Florida. It's very interesting about, yes, there were some big schools there, but it's interesting how a lot of these sort of, I don't want to call them second tier schools, but sort of these lesser known schools are putting people into the first round that, had you not really watched a lot of the draft previewing, you would have never known any of these people. And so I find it fascinating every year to watch this because there's always a boom and there's always a bust.
Always a bust.
So it's always fun to see.
How do people get a hold of you?
So the best way is just to type my name into Google. Chad is easy to spell. My last name, Cascadden. You can just type Cascade dishwasher up that, those two words usually put together. It'll lead you to my LinkedIn page or it'll lead you to my Twitter page, and you can contact me directly through either of those. That's the best way to get me. And fortunately enough for me, and I checked, I'm the only Chad Cascadden in the entire world.
You can tell Melissa you truly are one of a kind.
I truly am one of a kind. There is no other Chad Cascadden, if you can believe it.
Fantastic. Chad, thanks for your time, man. I really appreciate it.
You're very welcome, Mike. Always a pleasure.
Buddy. Talk to you later. Well, I hope you enjoyed listening to Chad, sprinkling in some football with investing and other things, like talking about sales a little bit. So here's coming up now, we're going to talk about the world of short selling and what to look for. Rob McArthur is going to join us from Alternative Research Services, and he's going to lay out for you what a short seller looks for and what you should be looking for. If you don't want to short stocks, that's fine, but you might own something in a portfolio that a short seller is looking at. So I'm going to bring Rob on now. Rob McArthur, welcome to the podcast.
Hello.
So I was trying to think, Rob, you and I have known each other probably since 1996 or 1997. And yes. I was an analyst in my very first job at a small firm, and you and I, you were working as a sell side salesperson at a firm in Connecticut, at a small firm, and I was at a small hedge fund. And we had been working on an industry that we thought was full of fraud, and you were working on an industry that you thought was full of fraud. And the hedge fund world is a small world, and Wall Street's a small world, and we met, and that was the for-profit education space. And I was thinking back, and we'll talk about that in a minute, but I was going back, and so we have known each other over 20 years, and you are a short seller. And I say that with, this podcast goes out to tens of thousands of people, and the listeners are all shapes and sizes. I do it because I want to do it for ordinary investors to help them level the playing field versus professional investors. But we got professional investors who are listening to this. And one of the things, Rob, as my career as a short seller, I have, you hear people say, oh, a short seller, like, oh gosh, they're bad guys, or, oh gosh, they make stuff up. And I it's comedic because the short sellers do, to me, I mean, the guys I know, you being one of them, do the most thorough, the best, the deepest research. And for those bad guy short sellers out there, I haven't met one yet. They may exist, but I don't know them.
I don't either.
Right? I mean, it's kind of like trying to uncover all the BS that goes on Wall Street. So
yeah.
Tell listeners who Rob McArthur is. Give us your background.
Sure. My name is Rob McArthur. I started Alternative Research Services in 2005. Prior to that, as you commented, I started at a no-name broker-dealer in Stamford in 1994. And they basically gave me a desk and a computer and said, if you can survive for 6 months, then you can stay. If not, you're fired. And I stayed 12 years. Yeah. Before leaving the firm to start my own company. And
you did something different, though, because most guys, when they start at a firm like that, folks, we're not talking the Morgan Stanleys or Goldman Sachs's of the world, where they have institutional research and the job of an institutional salesperson. And Rob, you'll see during the podcast, I will I will, I might cut you off, and I apologize for that, but I'll explain some of the stuff we're going to talk about because right. So if you're a Goldman or Morgan Stanley institutional salesperson, your job is to liaise with the professional investor, being a mutual fund manager or a hedge fund manager, and you take the information that your analysts have and the research that they put out, and you synthesize it, the professional. So, but Rob's job was chief chef, cook, and bottle washer. So Rob had to come up with his own investment ideas, whether they be longs or shorts, and he had to be able to sell those to a real finicky and grouchy group of guys, hedge fund managers, and show value where most of the hedge fund managers then and now are skeptical of sell side research because it has an agenda most of the time. So now here you are as a young guy with a desk and a computer having to convince investors who really don't want to take your phone call that you have an idea that's pretty unique and different. And the way you do that, by the way, folks, is the way you tell a hedge fund manager that is, I got a short idea that you're really going to like, because shorts are hard. And so if you can help them there, that's it. And that's what you did. So what did you do? How did you get into the world of short selling?
Actually, when I was 23 and unemployed, my dad was kind enough to start teaching me about the markets. I had no interest in the stock market. Before that, I was kind of a hippie, to be honest. And so he said, there's kind of a conflict of interest going on whereby the big wirehouses, Morgan Stanley, Goldman Sachs, cannot recommend stocks as shorts because it might trash their investment banking relationship where they really make their money with the company. So if one of their lowly brokers, some satellite office recommends XYZ as a short, you're going to get a call and you'll probably get fired. And so I started out, I don't mind. I hope you don't mind if I give you a little bit more background.
No, Rob, go at it. Have at it.
So I got an interview at Janney Montgomery Scott, which is a retail brokerage firm, a very kind of conservative place, 40 offices. And there was a kind of a retail broker who had lots of different businesses. One of them was selling third-party research to hedge funds, and he handed me a list of products that they sold, and there was like Bloomberg on there and newsletter services, and 2 or 3 of them were short sell research services. And so I decided maybe I could, if I bundled these together. I think it was David Tice's product, obviously off Wall Street, who's a big, well known in the short community, and I can't remember who the last one was. Probably Howard Shillett or something. Yeah, it was Howard Shillett. So, and being 24 and naive, I called Lee Cooperman, and I called Jim Pilata at Tudor, and I was trying to get Mike Steinhardt on the phone, and so I called the biggest names in the hedge fund industry at all hours of the day, trying to get in to actually get them to meet with me. And Cooperman actually was kind enough to meet with me. My dad worked at Goldman Sachs with Lee, and so I got in there, and he bought at least 1 or 2 of the services. So I was successful there, and I was calling particularly Mark Roberts of Wall Street. I told him, I said, if I'm going to be marketing your product, then you have to teach me how to do fundamental analysis. I have a political science degree from American University, a lot of philosophy classes, but no formal financial background. So my dad, Mark offered to give me some quote training in the ideas so that I could sort of think of how an institutional hedge fund manager might think when looking for short research. So, Rob,
I'm going to cut you off there. You said something really interesting, and one of the things that it's fascinating. So you have a degree in politics, and you approach from a philosophical standpoint. You don't need a business degree. You don't need an MBA. You don't need to be any of that to be a good investor. You need to be open-minded, well-read, and curious. And so it's Great. I've met so many good investors without any type of formal business training. You could be talking to this.
You just have to be able to think outside the box. And, as I started listening to conference calls, and sometimes I could get my hot little hands on some street research kind of to see how those analysts were thinking. And like sometimes they didn't match up. Like I'd hear XYZ on a particular conference call, and then I look at what the analyst published the next day. I'm like, what kind of like story are you writing here? Because it doesn't even reflect what the management's saying, and I don't trust what the management's saying in the first place. So,
right.
So the analysts were incredibly biased because they wanted to get their the investment banking business from a particular company that they would, be covering. And so I thought, well, if that's true, then there's going to be an anomaly in the market if everybody's, writing these sweet little stories and creating essentially overvalued companies. And that would create a great opportunity for a short seller who, like me, and I did a lot of investigative journalism type of things while I was in college. And so I thought, well, if I, can get my hot little hands on some proprietary information that the street doesn't really know about and the company doesn't want anybody to know about, then maybe I could provide some value added to institutional investors. And
all legal, all legitimate by information. You're talking about information that's out there in the public domain, but just not bundled up for people to go consume and you're just going out and doing field work and trying to look at things differently.
Well, at that time, as you know, the internet was not really in full gear at that point. American Online, I think, was just, sending everybody CDs to see if they wanted to log on. But that was sort of the full, and Google was one of like 15 search engines out there. And, nobody could pick a winner from that list. 15 would go bankrupt and the 16th would go to $1,000 a share, which is pretty much what's happened. And so I moved over to Access Securities, which is an execution brokerage firm for quantitative money managers. So this is in Stamford, Connecticut. And so they were executing millions and millions of shares per day for large pension funds, institutions. They had no research department. They had no investment banking. They had nothing. They had very little in the way of infrastructure, except for some really good, traders who could help get the best average price when executing a multi-million share trade. And so I went off into my little corner, and I thought, well, okay, I like the idea of short selling. How am I going to make a living? And so I literally started calling hedge funds all over the place. And I said, well, would you be interested in short sale research? And they say, well, what do you got? And I say, well, I don't have anything yet, but tell me what you might be interested in. So So I went at it in kind of a, back ass kind of way and said,
I have another guest on today's show who was just talking about that. When you're selling something, it's really nice to have someone ask you what it is that you need. You don't see that a lot. I literally had that conversation where, as a consumer of research, how many guys sat in front of me and told me what they had rather than asking me what I needed. So that was a great way to go about it.
I was more than willing to be a gopher for 10 or 15 hedge funds if I had to. And I walked into in kind of an entrepreneurial kind of way in hindsight. I just said, tell me what you want. Tell me what you need. And, I had this list of prerequisites, and there was some overlap with all of these funds. And, Access Security said, the chances of you getting something proprietary that they don't have is slim to none. And if you do get something, probably you shouldn't have it. So they were a little nervous, but definitely a team player and willing to cut me some latitude in my research. And so that began a learning process. And, with your former firm, for example, I did some investing that was slightly unrelated to some of the fundamental analysis. So I had my fingers in a lot of different pies with different trading styles and trading activity and technical analysis and economic thought. And, there's a million ways to make money in this business. Pick one. I tried to pick 5 just so I could live through the first year. But really very quickly, my passion was to uncover information about a particular company that that people didn't really know about. And as you know, the rules back then were a lot looser than what we have today, with regard to finding sources and compliance in terms of how you contact those sources and so on.
Well, it's interesting, Rob. So for me, when we were back, and we'll talk for-profit ed for a little bit,
sure.
When back in and I forget 97 or whatever it was, we started looking and seeing this industry that was growing rapidly, and the sales were growing. Wall Street loves sales growth, and the cash flows were growing. Wall Street loves cash flow growth.
Yeah.
And what we started seeing was a disconnect, though, between the sales growth and some of the things on the balance sheet, and that didn't make sense to us without getting into details. And as we started looking at it, we said, wait a second, something doesn't seem right here. This industry is growing because the government's throwing a lot of money at it in the form of loans, and these numbers don't make sense. So how do we prove these numbers? And that's where we went out, and gosh, when I was a young analyst, and I would go into these schools posing as a student, and I'd get them I'd take, right, and we'll talk about the work you did on it, and I would get them to get me through the enrollment process, and I would take the test, and the test would be a 50-question Wonderlic exam, and I would purposely get every question wrong, and they would tell me I had the best score, and I would change into construction clothes. I'd go to a paint store, put paint on me, and I'd say I'm just moving to the city. And
did you really? I never realized you did that.
Yep.
That's awesome.
Yep, we did that, and a mutual friend of ours who shall go nameless down in Dallas, and did that as well. And we would go all over, and we would then take our information, and back in and it still is to the days where one person is allowed to record a conversation without the other knowing. There are certain states you can, and certain states you can't. And, in the states where we were allowed to, well, that's what we did. And we would take that information and we would share it with the powers to be at different state and federal agencies, as I know you did. And the beauty of this is, and this is really so fascinating, here we are, before we really were talking about this, we're doing our work on this. And here you are seeing something in the numbers that didn't make sense to you, and you're off doing your entire different work on it. And doing deep dive research, talking to former employees, and talking to students, right? We used to go hang out in the parking lots, and on the smoke break that they would take, they'd come out, we'd talk to them, and they would tell us how bad it was and how hardly anyone was finishing, and they lied to them about the job placement rates. And as we started you started talking to us about the idea, we started comparing notes. And then others in the industry, right, started doing the same thing, other short sellers. And then you share insights and thoughts, and you say, my God, we're all coming at this differently. We're all doing different types of work. And holy cow, look what we have. And so you were so dogged back then. And, this was over a couple of year period. It was for me, it was the art of short selling, because at $8 and $10, we thought we had the stock was $8 or $10. We thought we had the aha moment. We had everything. We shared it with who we were going to share it with. We went down to DC and had lunch with staffers on the education committee, the stock went to $35. And nobody cared until the FBI raided the company. And you had been doing so much work and dealing with the Department of Education and the Office of Inspector General.
Yeah.
Right. And
those were the days.
Right. Those were the days. But that's what it took. So talk about, and you wrote a book on it. You wrote a book on the for-profit education space. So talk about the process of doing deep dive research, like what Rob McArthur at Alternative Research Services, what you do now and what you did then. How do you put a mosaic of information together? And why do you do that? Because some of the listeners read a research report from Morgan Stanley or Goldman, and I'm not picking on them. It could be anyone. It could be, I'm just naming some names that come to the top of my mind, and think that, this analyst wrote it. It's a big firm and it must be right. So start from there. Like, how does your process work?
I'll mention 3 short stories that I did prior to doing the Computer Learning Center and the rest of the for-profit education companies. Yep. One of them was a company called Cannondale Bike, which every bike rider in the country knows that company. And so one of the things I did, and as you know, there are formulas for analyzing financial statements. I looked on the company's balance sheet, and and these were really nice bikes. They're like $1,500, $2,000 bikes, and you shouldn't have any kind of problems like what I saw. And the first thing I noticed was that the accounts receivables, the money that was owed to them by their customers, was about twice the size of their sales. And so they were making sales and more sales and more sales and never getting paid. Mm-hmm. And I thought, well, that makes no sense to me because this is supposed to be a really high quality product. And luckily for me, the company put all of the bike stores in the country they had as customers on their website. And so I called, I don't know.
The days when companies were naive.
Yeah, exactly. I mean, now they try not to tell you anything, but anyway, so I called like all these stores around and I said, hey, how come you're not paying Cannondale Bike for these nice bikes that you, that you have and you bought from them? And they said, well, it's made of titanium and the titanium is actually causing cracks in the frame. So whenever anybody buys a bike, they come back a week later with cracks all over the frame. And I thought, oh my God. And so I said to the guy, it's like, well, what are you saying? And he said, well, the company won't take the bikes back and we refuse to pay them until they do. So the stock was like 25 at the time. Unfortunately, it didn't trade a lot. So a lot of the hedge funds, back in the day at that time, running $100 million was a decent sized hedge fund. It's not like today when everybody's got 5 or 10 or $15 billion hedge funds where the liquidity demands for the portfolio manager is much higher. And it causes you to short much higher quality companies where you have managements that are less likely to be committing fraud. And I think that's a problem in the hedge fund industry.
It's interesting you say that. So it's less likely to commit fraud, but one of the things I've noticed the last few years is easier to find shorts in the one regard. The complacency in the market has caused people just to overlook with liquidity in the market. So the liquidity has created so many big, mid to big names trading outside what their capabilities are, really, if you will, meaning the fundamentals are nowhere near where the valuations are, and you start to see some of them start to fundamentally slow down. But totally your point, I get 100%. It's harder. It's hard to generate positive, good returns on the short side.
You're lighting me up a little bit because there's so much growth in quantitative money management, Renaissance or whatever firm you want. They're huge and they're everywhere, and everybody's got an algorithm for picking stocks, and you can't argue with an algorithm. And so you can't say, and actually I'll finish the Cannondale Bike story in the same way, because I won't name the name of the mutual fund, but they owned like 10% of Cannondale Bike. And I called up one of the hedge fund analysts and I said, look, I'm working on this as a short. And he said, well, we can't short that because we own 10% of the company in one of our long portfolios. This is a large mutual fund company that had a small hedge fund, that I had as a client for several years. And I said, you mean there's no analyst, there's nobody who can pull the trigger to get you guys out of what's basically going to go to zero? And he said, no, it's owned in one of our mid-cap funds, and there's no discussion about how it picks and buys and sells stocks, and that's the end of it. And so sure enough, the company went bankrupt. So the stock went from 24 directly to zero, and anybody who was a quantitative investor, including this guy, lost everything because there was no fail-safe to get them out of a position where the financial numbers were completely incorrect, inaccurate, and bordering on criminal if you want to push it. But so the quantitative management style has really is creating structural issues in the stock market that are bad. As the fundamental analysis becomes more marginalized, it's creating greater risk.
It's true. And you know what I've seen, Rob, is really it does but it seems until it doesn't. And so, last year I was short Dean Foods and Newell Rubbermaid, and these were companies that were they both got cut in half. But what was happening though is you were seeing unnatural price movements, and because the numbers were going up, the margins, the earnings, and I don't know if it's the algorithms kicking in, whatever it is, taking these things where, in these cyclical industries or in a roll up like a new Rubbermaid at the time, the algos are forward looking or in real time looking, but if you really go out and just have that blank canvas and you start to do analysis like you did on Cannondale, and you see things in the numbers underneath the surface that go into the numbers, you could really find some interesting ideas. And like Cannondale, why are your receivables growing twice the rate of your sales? Something's not right there.
Exactly.
Right. And Wall Street loves a good story. And, story stocks are another great short because you get a really good salesman that's out there as a CEO, and he could really paint a great picture. Often and quite often it's not the reality. So Cannondale was one. Give a couple other examples that you were.
One of the things that I do as a short seller, and I think a lot of people can identify with it, is selling short companies that have made a very large acquisition. So your sales after you make an acquisition, preferably at least they made an acquisition in their core business type company, but for the first 4 quarters, the sales are going to go up 30, 40, 50% as you add the new company on top of it. So in the 5th and 6th quarter, all of a sudden the growth rates can from that high 30, 40% to maybe 5 or 10%. And, I always try to short things where the earnings are already starting to roll over, and the quantitative money managers will pick that up and they'll start selling the stock off. So I started working on Thomas Nelson was one of my stocks, and Thomas Nelson was, I got a lot of jokes about this, so don't bother. It's a Bible printer.
Mm-hmm.
And so they bought another Bible printer. And actually, there was an issue here of high inventory. So I called the company's warehouse and I talked to the supervisor on the floor, and I said, I'm an analyst and I'm looking at some of these inventory numbers. Why are they so high? And he said, well, the company that we acquired has a lot of obsolete inventory. We got it stuffed in the back in pallets and we're never going to sell it. I was like, that's kind of interesting. So, eventually the auditors made them take a write down for obsolete inventory, and it damaged the stock pretty hard. And, it was a nice short that worked. Now today, compliance-wise, I'm not sure I would be allowed to call the floor supervisor in the warehouse, but at the time that was not a big deal. One of the other kind of more fun shorts I did was a company called Cryptologic, and Cryptologic was an online gambling company operating out of Antigua. So I started digging on it. I found out there were these 2 Russian guys in Canada that developed this online gambling, and that they had it but it was being run out of Antigua. So I did some research on the guy who was running it, and he was wanted by the FBI. He couldn't come back to the United States. He had a rap sheet that was a mile long of being kind of a scummy gambling type guy. And so I wrote a couple of reports, and it was popular on the long side with a couple of hedge funds, but so I made myself unpopular with a few people, but it's like I care.
Can't please
right?
all the people, Rob.
Yeah, no kidding. So anyway, so I get a call from CBC, which is Canada Broadcasting, which has a fundamental equivalent of 60 Minutes, and they ran a piece just like 60 Minutes has done in for-profit and other companies I've been involved in, where they went down to an Antigua and interviewed this guy, and he said, "Oh yeah, I can't go down to the United States again. I do have a warrant out for my arrest or whatever it was, but Antigua's really nice. Look at my nice house. It's like he's got pink marble house." I'm like, oh my god, tell me this isn't like Scarface or something. But anyway, and So the authorities, I think it was probably Canadian authorities, went in and shut the company down from Canada. But one of the quotes I found was a guy at the Canadian, the Royal Police or whatever it is, and
Royal Canadian Mounted Police. We have a lot of Canadians listening. You got to get that right.
Sorry, I appreciate it. Because
I'll get a lot of mail.
Sorry. Anyway, so this guy said, and this goes way back. This is like 1999 now, 1998, that online gambling casinos could be used to launder money by terrorists. And I threw that in there. It was kind of a cool quote, and I didn't think anything of it. And the stock went to 22 to 0. And years later, like 2 weeks after September 11th, I got a call from Department of Treasury investigators saying, "Hey, we heard you know something about terrorists using online casinos as a way to launder money. Can you tell us anything that you might know?" And I was like, "How'd you get my name? I wrote that report like over 10 years ago." Right. They didn't even want to say, and I didn't have any information for them, but I thought it was kind of interesting.
Yeah. That's funny.
Somehow my research report made it up the chain of command to somebody.
So let's move the clock forward now. So here you are. You got all this years of experience. You're a dyed-in-the-wool short seller. You're out trying to find these that either the fundamentals don't warrant where the stock is trading and they're about to turn over, or you're looking for fraud. So help listeners understand, because they may not want to short stocks, they may not want to buy puts, but they may own stocks that fit the description of what a short seller is looking for and stuff that's about to or could potentially go down a lot. So what's your playbook? What do you look at?
Well, I look for a couple of things. Call it the cockroach theory, that if a company misses numbers, it kind of knocks the wind out of the sails of the momentum players and the quantitative managers. And so they start to become sellers rather than buyers. You know, stock only goes up as long as somebody's willing to buy more. And if the earnings revisions are constantly going up, the quantitative money managers will continue to stand there and buy the stock no matter what. However, I think of like the shape of a bell curve. When a company misses that first earnings report, it's at the top of the bell curve. However, if they miss the following quarter, the stock does a staircase or it has a huge drop, and the earnings start to flatten out or possibly turn negative. So if your earnings growth is 20, 25, 30%, even a couple of years on a stock you own, and then all of a sudden it goes 15, 12, 10, you know that there's going to be some PE compression automatically there. And it doesn't have to be a fraud. It just has to be a company that has experienced slowing earnings growth. And that's kind of an easy tool for short selling. If you can at least be reasonably right on the timing. I mean, if you try to short a stock before an earnings report and the stock's at the 52-week high, as you know, you'll get carried out in a stretcher, because a lot of short only funds or long short bias funds, got carried out during the internet bubble trying to sell short Yahoo at 250 or whatever it was, the insanity of the day at the time. And so I think I certainly learned the lesson. I would never recommend stock at the 52-week high in anticipation of a slowdown in earnings, because you never know how the management is going to cook the books on the earnings to beat their numbers. I mean, right now during earnings season, everybody is reporting these tremendous earnings, but their tax rate's gone from 35% to 21%. No wonder they're reporting great earnings, but it's a detachment from the fundamentals, in my opinion. It's a one-time gain.
100%. Rob, I'm so tired of hearing prognosticators or talking heads or whomever it is, monster blowout earnings, great phenomenal earnings growth. It's the most anticipated earnings strength in that I could remember in a long time because of this.
It's a gift.
Right? It's a gift. And look how they're reacting, right? The market is still down, even it had a day up yesterday or so, percent, but from where it was just 8-10 weeks ago, And with these monster blowout earnings, the market's kind of saying, yeah, we kind of get it.
Well, as you and I discussed, we've been working on some subprime borrowing trends in automobiles, and the mortgage trends seem to be changing. If obviously rates are going up, and mortgage rates seem to be going up much faster. So we actually had kind of a trading call out on LendingTree, and it was 400 in December, and today it's 244. It went down 60 points or something yesterday, and now down another 15 this morning. So that's all the momentum players that own the stock for 2 years, and in 2015 the stock was 50. So it's gone all the way up from 50 to 400. Pretty good return, but. I think if I recall from the press release, their EBITDA missed earnings estimates by like a couple of percentage points, and there you see the quantitative money management firms out there saying, well, that must be an indication of a slowdown in earnings. I'm out of here, and they try to get out, unfortunately for them, all at the same time.
So let's talk about the subprime auto, because it's something I've been spending a lot of time on, and it's quite intriguing to me. What's your view?
Well, I mean, because interest rates are going up, I mean, you have a big generation of analysts in our industry, including me to some extent, don't have a good working knowledge of how a stock market performs in a potentially rapidly rising interest rate environment. I mean, you may have to go all the way back to the 1970s to see like what the total devastation is. But when interest rates have been down or flat under Janet Yellen for so many years, and then under the new president, they've decided to raise interest rates, and that could cause some inflation. Oil has certainly been very strong. And we think that the consumer has been just absolutely devastated so much from the subprime lending with mortgages that they may not really have recovered, because we found so much aggressive lending to people that have a FICO score under 620. So there's a lot of people who in this country who live paycheck to paycheck, or don't have a couple of months worth of money in the bank in case they have
and Rob, and the headlines, right? You wouldn't know that by listening to the headlines. The economy's great, the consumer's doing well, a jobless rate is at its lowest in decades, right? So that's kind of what you see. But when you analyze the numbers underneath, it tells a completely different story.
Well, I'll throw a couple numbers at you here. 49% of Americans are currently living paycheck to paycheck. So what kind of purchasing power do you have if, let's say, that clothing and whatever gets, has prices go up? You're going to be able to afford less. 61% do not have enough money saved to cover 6 months of living expenses. 78% are not ready to search for a new job. 64% do not have multiple streams of income. 68% say their investment strategy does not account for a possible recession. And I footnoted that from something we were doing for our research report. But I mean, the credit card, we're looking at the credit cards and the auto loans. I mean, well, let me preface. If you look at it, there's, a couple of different kinds of debt. You have mortgage, you have credit card, you have student loan, personal loans, credit cards. And you can move yourself around in these different pools to try to get money to cover some of your other problems. And so we found that people need more and more credit cards, that the number of credit cards the average person has in the last couple of years has gone from 5 to like 10. So they're floating themselves just by paying off, and they get an introductory zero interest, whatever. And that's the reason they do it. And now from 2015, we've gone from 800 billion to $1.1 billion of credit card debt outstanding. And student loans are at $1 trillion. And mortgages are around 8 trillion. And So we think that the consumer, if they are going to be cut off from having access to money, because there's so many people in the subprime category, we've noticed that the auto dealers are like just as bad as the subprime mortgage brokers. I mean, we've found instances where they were, we went to a dealership here in Connecticut, and they said we could put $8 down and drive out with a brand new SUV.
Yeah. Yeah,
$8.
And you're seeing it as I've been looking through some of the securitization pools on some of the subprime auto stuff, and as I see the tranches in there, AAA, AA, yeah, okay. The default rates on some of these are 9, 10, 11, 12%, 60-month loans, loan to values of 120%. Now, I don't, at 1.2 trillion, the auto cycle is not enough, I don't think, probably to take the economy down, but it's enough to hurt a lot of people. And I think there's complete complacency in the market, and I'm doing work on that stuff now.
I'll try to take it a little bit of a step higher. What happens if people continue to declare bankruptcy over and over again, as much as they're allowed to within the law every 5 years or something? And what happens when the credit cards say, hey, we get blown out when somebody declares bankruptcy? We are no longer going to give that person any access to credit cards because they can't prove themselves to be, fiscally responsible.
Yep.
And therefore you could have right now people are just getting dragged in and out of the debt markets because they need to have access to these debt, and the industry just scalps them with high interest rates. We're seeing interest rates on cars like 20% plus.
Yeah. Well, you mentioned something on interest rates. One of the arguments I hear from people is, who cares? The interest rates are so low. Even if they go up on an absolute basis, it's only 3%. Or who cares about the 10-year 3% here? Because, like you said, Rob, interest rates have been on a downward trend for decades, right? There's been blips where it goes up, but down. You live, and people could say, well, it was higher at certain points in time. It was 5%, it was 6%, it was 7%. Yes, but you live in the environment that you do today, and this debt is incurred at this price, and these credit cards adjust the interest rates up from the lower rates. And companies live in a world where their variable rate loans and people's variable rate mortgages are coming from a lower. It's all about the rate of change. It's not the absolute number, because the time periods you're talking about are based upon loans that were given a few years ago. And so it's really fascinating to me. And I think people who talk about rates were much higher, they're completely missing the mark.
The rates were abnormally low, and that's been a good thing. But if, quote, poor people or whatever can't survive as well or at all in an environment where the 30 years at 4.5% or 5%, because as you know, mortgage rates just don't go up at a commensurate rate to the rise in interest rates. They go up at a greater rate. Like the volatility is probably almost twice. And I think that, what the federal rates are. So I think that 30-year mortgages are, 4.5. I think I see some 4.25 around. It's not going to take much if they're going to put a couple of more, 25 basis point raises between now and next year or something, for those rates to get well over 5%. So we've been tracking the mortgage refinance market, and so refis are actually getting killed as the rates go up. You would think people would refi as fast as they could, anticipating that 30-year rates could be or mortgage rates could be at 7. When I bought my first house in 1995, rates were 7%. I mean, and that seemed normal. So to have a 30-year mortgage available to you for under 4% for 10 years is an extraordinary thing. And one of the things with the subprime lending crisis was that people were given access to home equity lines of credit out of the equity in their home to use for other purposes. Their homes became an ATM machine to pay for other forms of debt. And we have seen some signs that home equity lines are going up. So one of our subprime, concerns is that people will have, drier, have their liquidity dry up. But if they can access the home equity lines of credit again to pay down, car loans and credit cards, then our thesis might be delayed, at least on a short-term basis. But we think the consumer is just, and you can see it from the retailers last year. I mean, the retailers, Toys R Us and all the big bankruptcies of, companies that have been around forever. It's really a bad sign for the state of the consumer's willingness to spend. And anybody walks through a mall after the day after Thanksgiving or Christmas or whatever, everything is like down 75, 80%. I mean, these are discounts I think are unheard of, and clearly they're just selling things at a loss.
Yep. Well, listen, this is great, Rob. So how do people tell us about your service? How do they get a hold of you? What tell us about alternative research? You're more institutional geared, I know that, but so tell us about what you do.
Yeah, I'm only institutional geared. I've just chosen a business model where I could service, a handful of large hedge funds. We charge $45,000 per year. We do 3, 4, 5 ideas per year. We publish, 10 or 15 reports on each idea per year. So we're researching and publishing a lot, and we do that because, I sat in front of a hedge fund manager a while back, and he said, I want to short $500 million in one stock as a short. So if you're going to pitch me on an idea, you better be able to write a book about it at the end. Know the company better than the company knows itself. And so as you know, I like to send the federal government Freedom of Information Act requests, and we find out problems that get exposed in the FOIAs, government reports, investigations, things that the companies don't necessarily want you to do. So we really try to focus on a handful of ideas. And while we've been doing some of our subprime auto research, I can mention some ideas, like trading ideas that along the way. So for example, I recommended LendingTree. I think I said it 335 like a month ago, saying, hey, their mortgage business is already slowing, and how many, and we look at lending clubs, they're constantly throwing out these securitization portfolios, and if those portfolios, and I think you mentioned it too, are slowing down, if they can't sell those portfolios as quickly, and then LendingTree's business could slow down dramatically if the economy turns south. So I can throw out some thoughtful trading ideas, but really I'm trying to do the deep digging, looking for frauds and staying there for 2 years kind of thing.
Great. Well, listen, so how do they just go to your website, or what is that? How do people?
My website is www.altresearch.com, altresearch.com. And there they can look at some of the stocks we've done over the years. Sam Adams was a fun idea. Ruger we've worked on for the last couple of years. That's been kind of a difficult stock. COF, Capital One Corporation is a stock we're recommending. And Tempur-Pedic.
Recommending as a short, you mean?
Yeah, Tempur-Pedic is a stock we used to recommend. The Sam Adams is not current, but Capital One is current. So there's quite a few ideas that we've generated over the last several years.
Well, I want to. Listeners might say, ask them about Capital One. Your existing client base would be upset if I drilled too deep on that, so I won't do that. But is there a quick synopsis you'd want to give on Capital One?
Well, yeah, Capital One is interesting because and we've been talking about the auto loan business, so this is why I'm focusing in on that. Capital One. Let me see if I can pull up my.
And by the way, I for full disclosure, I've been doing research on it as well. So, and we didn't talk. So.
Yeah,
You had sent me a report on it yesterday, and I thought, oh, that's interesting because you're looking at it too. So
yeah, well, I saw your lecture about cars coming off of leasing or whatever that. So I was like, oh my God, he's doing the same thing I'm doing. That's a good feeling. Anyway, so not everybody, but the top 5 banks who have been in the auto loan business, Ally Financial, JP Morgan, Wells Fargo, Capital One, and Bank of America, the top 5 banks, represent a large portion of the industry, 25%. So there's total loan value of $1.1 trillion outstanding, up 4.7%, versus last year. And Wells Fargo, for example, has decided to exit the business, and their portfolio declined 12%, but Capital One's portfolio was up 15%. So everybody is basically exiting the auto finance business or trimming it down. JP Morgan was flat, Bank of America was up 5%, Ally Financial up 3.5%. So we think that Capital One is either really smart or really stupid, and we can't figure out which one. I think what they're trying to do is to buy some of these non-performing portfolios, non-performing assets that may have a 10, 12, 15% default rate, and trying to buy them at 50 cents on the dollar instead of buying them on, let's say, historical rates of 80 cents on the dollar. Portfolio Recovery Associates has kind of a similar business model here. So they're trying to buy some of these portfolios, we think, at a deep discount, and then try to figure out how much money they could recover versus historical, and maybe do a little bit better. Either that, they're just taking the risk of being in a business that's very high, a very high risk business, because the margins could be there, and I think the margins on their credit card are not great and getting worse. So it could be a forced choice into something that might be higher margin. We haven't quite figured it out, but I'm definitely trying to look industry wide here at the portfolios of loans that are starting to not perform, and where are they going? And if people are saying, well, we're not buying any loan portfolios, and we're like, well, are you selling them? And then they turn out they're not selling them either. Well, how many are they holding that could be, not mark to market correctly? And, you don't have to look very far back to, Lehman Brothers and so forth to know that maybe those portfolios are not being marked to market properly because they're not performing. So that's kind of a summary of kind of our long-term thought. And, the reserves are moving all over, but I'm not really looking for quarter to quarter on this. I'm looking a lot longer term.
So, Rob, you just said something that's really interesting. You're still trying to figure it out, but you're not there. But you have a thesis, and that's kind of with my subscribers. I tell them, I have a thesis, and it could be early. It could be that I think it's going to unfold in the next few quarters, but it might happen before then, but it's not yet apparent in the numbers, and people, the investors yet aren't believing it. And so, start out small in the position, and it could be you start out at a quarter of a position, a third of a position. If the stock rallies, you scale into it, dollar cost averaging in reverse. But these things don't just pop up in one moment and say, okay, here I am, I'm a short. But that's how it works. So listen, Rob, I can't thank you enough for your time. I really appreciate it. It was great talking short selling with you.
Well, it's really been a lot of fun for me. I like talking to a like-minded short seller. We haven't talked a lot lately, but this has been a lot of fun, and I'm looking forward to working with you guys more in the future.
Great. Same here, Rob. Okay, we'll be in touch. Thanks,
Take
man.
care. Bye.
Bye-bye. I hope you enjoyed the double-decker interviews, the back-to-back. I know it was lengthy. I don't know if you listened all at once or you doubled down or you did it in two parts, but I hope you enjoyed it. I thank you for listening. Follow me on Twitter. I'm on there a lot. Footnotes first. I look forward to interacting with you. Until then, I'll see you next week. Have a great week.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.